A very good morning. I'm Dr. Vibha Jain, Associate Professor at Janki Devi Memorial College. I'm in the Department of Commerce taking Financial Management as my one of the subject. In Financial Management, today I'll be taking up Cost of Capital. Now the question here arises, what do you mean by the term cost of capital? The cost of capital is nothing but the minimum required rate of return. You have already done the capital budgeting, I did with you. And in the capital budgeting, we always take the minimum required of capital. What do you mean by that minimum required rate of return? Let me give you an example. That suppose you take some loan from the market, and that loan, that money you want to invest somewhere. That loan you have taken at 10% rate of interest in the market. Now you tell me how much minimum you want to earn from this, the minimum amount of the return. Whatever you have to give it to the bank people, to the person from whom you have borrowed, that is the minimum required rate of return, that is the 10%. Definitely, you don't want to earn only 10%. You will definitely like to earn more than 10%, but that will be the minimum because that is your liability. Okay. Therefore, the cost of capital is the minimum required rate of return a project must earn in order to be at the same pace. Okay. But then, what is the next thing? What is the importance and the significance of this? Because this is the actual rate of return. Now the question here arises that is it that you will always bought and borrow from only one agency? No, it's not necessary. You might borrow from the bank only. You might borrow from your friend also. You might borrow in the form of an IPO, the equity or the debenture or the preference or any other source of capital. But my question before you is that is it that you will be borrowing the amount at the same rate of return and from everywhere? No, you will not be. As a result, what happens is, might be if you borrow from the equity. Is it that the expectations from the equity is the same as the expectations from the debenture or from the preference shareholders? No, it's not the same. What happens is, it depends upon the risk which the person is having, that is the lender. Now, I have borrowed, suppose for the sake of an interpretation and for the sake of an example, let me tell you that if I borrow from my friend 100 rupees, now when I'm borrowing 100 rupees from my friend, is it my friend says, okay ma'am, I'll take 10% interest from you. Why she is asking interest from me? You tell me that. Why she is asking the interest? One factor is because she is lending me the money. As a result, for the same period of time, suppose she has given it for 1 year, that means for the same period of time, she will not be able to utilize that money for any other fruitful purpose. When she will not be able to earn the money on that, that means she is foregoing some amount of the interest. And when she is foregoing some amount of the interest, that means that interest she has to take it from me. That will be the opportunity cost of the capital. Another, you tell me, she has given me the money. Is it that it's a risk-free, though she has got the paper signed, she has put up all the clauses, but still the level of risk is there. She wants that means the compensation in the form of a higher rate of return to compensate the risk also. Higher the risk, higher will be the expected return. Is it okay? If any question is there, you can ask me. Fine. Another thing, the third factor would be, is it that if she has given me 100 rupees, she will not be able to enjoy the fruits of those 100 rupees. But I can enjoy the fruits, the benefits of those 100 rupees. That means I have to give her the compensation for that foregoing benefit. Okay, that is the third part, that why she wants the interest from me. Okay, the risk is there, the uncertainty is there. That means uncertainty and risk can be both the time. It can be that I'll not be able to give her the interest, or I'll not be able to give the principal amount also. Another important factor is that during the period of time, suppose she has given me the money for 1 year. Now, during this period of time, is it not that the inflation or deflation will be there? Might be the index changes. As a result, again I have to compensate her for that change in the inflationary index. Okay, why? What is inflationary index? What is inflation? That today if I can purchase a basket of goods for 100 rupees, is it that I'll be able to purchase the same basket of goods in the same 100 rupees after 1 year? No, it will, if it is an inflationary condition, then in that case it will not be possible. Might be I'll be needing 120 rupees for purchasing the same basket of goods. Okay, that means there is a 20% inflation in the index. Fine, in my purchasing power had decreased. Whatever I can purchase in 100 rupees 1 year back, I have to pay today 120 rupees for the same basket of goods. Okay, when I have to do that, that means all these 4 factors combined gives you the nominal rate of return or gives you the minimum required rate of return. Okay, and therefore I am here discussing the factors affecting the cost of capital of the firm. Okay, now what are the main factors? I have given you just the factor which leads to the interest rate. Okay, now the risk-free interest rate. Do you understand what do you mean by the risk-free rate of interest? Risk-free rate of interest is, I have given you all the factor, but there one of the factor was risk. Also, the compensation for the risk and uncertainty. But here I am taking the risk-free rate of interest, and generally we take the government bond interest as the risk-free rate of interest, and hence the real rate of interest has to be found out after keeping in mind the inflationary index. Okay, then the purchasing power risk is there. I have already explained it to you. Then there are different type of risk are there. One is called as a business risk. Now, what do you mean by the term business risk? As the business risk is more, the expectation of the return would be more. What is a business risk? Business risk, the business itself means that it is a risky proposition. Now you are expecting that yes, or all your product will be sold out, the operating cycle will be this much, the purchasing would be this much, the demand would be this much, supply would be this much. Now all these are on an expectation basis, and hence the business always involves the risk. Okay. Another is the financial risk. What do you mean by the financial risk? When I borrow the money from any of the lender, might be the bank, might be the equity, might be the debenture. You tell me, is there any financial risk involved in that? Yes, I do agree that in the case of the equity, the risk would be less. But in the case of the debenture, where the fixed liability is there, that it can be a debenture, it can be a loan, or it can be any other type of a borrowing, where the fixed liability is there after every period of time, there the financial risk is there that might be as a borrower, I'll not be able to give back the principal amount or the interest amount. As a result, the variation in EBIT will lead to the risk. If in any year, though no cash flows are there or cash flows are less, yes, the financial risk will be there, and in that case, I'll not be able to give back the money, okay, or my liabilities. I can say that. Then there are so many other considerations are there. It can be the liquidity, it can be the marketability, or any other thing in the case of the investment. Because of the demand and supply factor, demand and supply gets changed. As a result, the other considerations are there which affects the cost of capital. Okay, now therefore, if you have understood that, you can say that nothing but the K is equal to IF. What is IF? The interest-free rate. B is the business rate, and F is the financial rate. That means I can say that the cost of capital K is equal to the cost of capital of the different store, that is the risk-free rate, the business risk, and the financial risk is equal to the cost of capital, that is the minimum required rate of return. Now, the minimum required rate of return can be of two types. One could be the explicit cost, another could be the implicit cost. Now, what is an explicit cost and what is an implicit cost? explicit cost is the cost which is being written at the time of the contract. Let's suppose I am giving it in the fixed deposit or I am borrowing from them. Then in that case, the bank says that, okay, ma'am, your loan will be approved at 8.9%. Now, what is this 8.9%? This is called as a explicit cost. But if they say, okay, I want to go for the investment, I have invested 100 rupees, but that 100 rupees will become 189 rupees after 5 years. Fine. Now, in the contract, it's not written that what is the rate of interest they are giving it to me. But here, because 100 becomes 189, that means I'm getting some return. Now, what is the rate of return? That is called as a implicit cost. Okay. But the question here arises, how to measure the cost of capital? I've just theoretically discussed that what are the factors that it should be. Remember that cash flows will be the base for measuring the cost of capital. That means in the previous lectures when I did the time value of money, there I told you that how to calculate the rate of return. It's nothing but then when we equate the cash inflows, the present value of cash inflows should be equal to the present value of cash outflow. At what rate these two are equal, that will be the cost of capital or a minimum required rate of return. Okay. Therefore, for that calculation, there are certain assumptions. The underlying assumptions are there. And what are those assumptions are that business risk of the firm is unaffected. Now, what do you mean by the business risk unaffected? At the time of borrowing and lending, the business risk will remain same even after borrowing. Okay, that means business risk remains unaffected. Another is that EBIT to sales revenue remain constant after borrowing. That means that is the underlying assumption of the cost of capital, which I have already discussed with you. And another assumption is financial risk of the firm remains unchanged. What do you mean by, again, that it will remain unchanged? That means previous to borrowing and after the borrowing, the financial risk will remain same. That means whatever the additional borrowing the borrower has done it, that has got the same financial risk as previous to the borrowing. As a result, even after the borrowing or before the borrowing, it will remains the same. And hence, they say that it will remains the same. And remember, in the case of the cost of capital calculation, taxes have got a major role. What is that role? You tell me. Suppose I have borrowed money from somewhere, the bank or the debenture or anywhere. There the fixed liability of a certain percentage is there. You tell me interest paid is a liability or not. Yes, you tell me it is a liability. It is the thing which has to be paid every time, after a constant period of time. That means I think you people as the accounting people and the commerce having the commerce background, what you will be doing and what you can understand that the interest has to be debited as the cost of as a interest paid in P&L account, debit side of the P&L account. And if you are writing down anything on the debit side of the P&L account, that means you are treating it as an expense. When you are treating it as an expense, that means the profit will be reduced by that amount. You tell me, if the profit is being reduced by the interest amount, is it not that the tax liability will be less? Yes, the tax liability will be less. And hence, the cost of capital is definitely being affected by the cost of by the tax structure, by the tax rate, whether it is to be paid by the company or it is to be paid by the borrower. Okay, so please remember that we have to find out the combined cost of long-term sources of finance. It's a very important thing. Suppose I am borrowing it for 3 months only. Is it that that borrowing or that rate of interest will be included in the calculation of the total cost of capital? No, definitely no, because it is for the working capital finance. But if I am borrowing any amount of capital for the long term, yes, that interest, that expense has to be included in the cost of capital. Therefore, please remember, whenever I'll be finding out the combined cost of capital, that will be only for the long-term sources of finance. But here, I have just understood from you that, okay, I'm taking the example of the debenture, I'm taking the example of a bank borrowing or any other thing. I'm asking you whether there would be any cost of the equity finance also. Suppose I have come up with the IPO. Okay, now IPO means, I think everybody understands, the shareholders have given me the money. I've raised that capital. Now, the definition of equity capital say that you are not to pay any amount to the dividend to the lender of equity shareholder or to the equity shareholder. Tell me now, when there is no liability to pay it off, whether you will consider it as a cost to the borrower, to the company? No. Here, according to the tax rule, it's not a liability. And when it is not a liability, you will not consider it as a cost. But let me tell you, if I am a shareholder, I have purchased one share of a particular company of worth ₹1,000. Now, when I have purchased, is it not that I have got the expectations to earn? Yes, I've got the expectations to earn on those ₹1,000. When I've got, as a shareholder, when I've got the expectation to earn on those ₹1,000, and if my expectation doesn't meet, what I'll be doing? If the expectations doesn't meet, I'll sell off the share and I'll purchase some other. I'll invest my money in some other avenue. Now, you tell me, I'm a rational investor. When I'm a rational investor, I want to earn, definitely. When I want to earn, that means I have got the expectations to get the return even on equity share. Please do remember, because every time the student says, ma'am, no liability, that means no cost. No, nothing like that. That means in the case of the equity also, the expectations is there, the cost of capital would be there, and when I'll be combining the combined cost of capital, because I can borrow 30% of the money from equity, 30% of the money from debenture, and other 40% from preference or from the loan capital. That means for the cost of capital calculation, from the point of view of the company, I have to combine 30% of equity, 30% of debenture, and 40% of the bank loan cost. Okay, therefore remember that we have to find out the cost of bond separately, the debenture separately, equity separately, loan separately, and whatever it comes out, I'll take up the weighted average and we'll go for that. Therefore, what I have to find out as the first one, I have to find out the net proceeds from the issue. I have to find out the default risk of the firm in order to find out the risk and in order to inflate that return, and the current level of the interest rate. Okay, therefore, I can say that the bond cost of capital would be equal to, that is being represented by B0. That means it would be FV. FV is what? The future value, that is the face value. Okay, now please remember, I'm using the word future value, I'm using the word face value. Do you understand what do you mean by the face value? Face value is the value, the book value at the time of the issue of the bond. That means the face value of the bond, then B0 is the net proceed, and then afterwards I'll take it up the PM, the premium charges, because at the time of the issue of the bond, you can issue the bond at the premium or you can issue the bond at the equity. So either if the premium is there, you have to add. If the equity, if the discount is there, you have to subtract minus F. F is nothing but the flotation cost. Flotation cost is one word which we are using, combining all the type of the cost which is there at the time of issue of the bond. It can be like the brokerage cost, it can be the legal cost, it can be the printing cost, it can be any other cost. That means flotation cost is one word which combines all the other things. Now, that means in the case of the bond, periodic interest is there, that everybody knows that after every period of time, whatever is the interest rate fixed, you have to pay every month, every period that will be there. And therefore, when the periodic interest has to be paid, you have to calculate the cost of the debt before the tax. Please remember, cost of capital has to be calculated in two ways. One, before the interest, and another after the interest payment, because I'll be getting the benefit. You just understand. Suppose the cost of debt is 14%. Okay, I borrowed loan at 14%. 30% tax bracket I am going in. Okay, that means I have to pay 30% tax. Okay, please remember this and understand just concentratedly. On 100 rupees, 14% interest, that means 14 rupees interest you will be paying. But I am in 30% tax bracket. So, आपने 14 rupees where you have written on the debit side of the P&L account. When you have written debit side of the P&L account, that means the profit is being reduced by 14 rupees because you have written there. Now that means how much less tax I have to pay? On 14 rupees, I have to pay 30% less tax. That means 4 rupees 20 paisa I have saved. Out of 14, that means, is it not that I have just taken up 9.8 as my cost? And that is the big advantage of the debt, that you get the tax leverage, the tax benefit out of that, and that is what here it is. Okay. Now, please understand that what is KD? KD is the cost of debt after the tax benefit, while KI is the cost of the debt before the tax benefit. Therefore, KD would be equal to KI into 1 minus T. Is it clear? That means here in my present example, the KD would be 9.8% rather than 14%. Is it clear? Therefore, the tax adjustment has to be made here. But now, the cost of debt in the case of a redeemable debt, the debt is always redeemable after 3 years, 4 years, 10 years, for whatever the period I have taken the debt. After that period, it has to be redeemed. It has to be returned back. Okay. Now, for that, I just told you few minutes before that we calculate the cost of capital. It can be debt, it can be preference, it can be equity on the basis of the cash flows. Okay. Just applying the time value of money. That means what I have written, try to understand it logically. I is the interest payment, then 1 minus T is the tax, that means 30% tax bracket is there, that means 30% I'll be getting the advantage and 70% of that will be the cost. Okay, that is 1 minus T I have done. Now that is to be paid after every year. Suppose it's a yearly payment, it can be quarterly, it can be half yearly, it can be anything. Now, that means it has to be discounted. That is, you have to find out the present value. What will be B0? It's the net proceed today. Net proceed, what will be the value of net proceed today? It would be the interest of the first plus interest, present value of the interest of the first, present value of the interest of the second, and so on. Go on adding up till the last year. And in the last year, you will be repaying the total principal also. That means, here the first thing is there. Now here, suppose I have borrowed it for 7 years. That means I will go from 1 to 7. Is it clear? Now that means I can write down here 7 times, but here I have written that raised to the power I, and where the I value is 1 to 7. Then what is COP? That is COP, cash outflow on account of the repayment. Fine. The repayment would be there in the ith year. Or it can be, that is again I, that is because there can be two cases. One case would be that when, I think you must have heard EMI. EMI में क्या होता है? It is some part of the money which you are paying is towards the repayment of the principal and some part of the money is towards the repayment of the interest. Okay. So in that case, if it is the EMI type of a case, then in that case principal will be repaid. That means on account of the repayment at the time of maturity. Is it okay? And therefore, this is the regular cash outflow which is there in EMI. And if it is not there, if you are paying only the interest, then in that case, the last year, the maturity period, at that time you will be repaying the whole of the amount. These two could be the two possible cases. Okay, and therefore the KD is the cost of capital after tax. Please remember this is after tax. KD. This is not KI. I have not written KI. Okay, now afterwards, what happens is, it consists, I have just explaining the second component, which I have already explained in the previous one, that this is, in the case of an EMI, the portion which you are repaying every year. Okay, now, in order to avoid this procedure, we can have we can have a brief, the shortcut method for the calculation of debt also. Now, what is the shortcut method? Now, remember here it can be called as shortcut method, or it can be called as a approximate method, because this method will give you almost the same answer as the previous method, cash flow method, was giving, but a slight point difference could be there, because here the basis is the average cost. There it was actual cost, the previous slide, but here it is on the basis of the average. Okay, here therefore a slight difference could be there. But remember and understand the logic of this formula. The first for the first case is I into 1 minus t, that is okay, that is the interest cost after the taxation. But what is this? RV is the redeemable value minus B0, that is the today's 0 period value. That is the redeemable minus the current price, or the value at the 0 period, upon divided by n, the number of years. That means, suppose the redemption you are making at 140 rupees, but today I have collected only 90 rupees, because 10 rupees has become the brokerage cost, the flotation cost, and every other thing. That means 140 minus 90, 50 rupees you are paying more. But this 50 rupees you are paying more over the period of n years. N years, suppose I borrowed it for 10 years, that means 50 upon 10. You are paying only 5 rupees per year extra. Okay, that means how much is the total outflow? The interest plus 5 rupees upon. How much is the average investment? Average investment is RV plus B0 upon 2. I think everybody knows the concept of average, that is RV plus B0 upon 2, that will give you the average investment. And therefore, because of this concept, this formula is called as a average cost of capital, approximate cost of capital, or a shortcut method of calculating the cost of capital. The same formula can be applied in the preference also, in the equity also, but with the different connotations. Okay, now remember, now what is there? That is the income tax provision. You have to really remember all those things. Now I'm taking the convertible debenture. This I can tell you only in this sense, that after whatever period you are converting the debentures into the equity. I think everybody knows the conversion or convertible debenture, that after a period of time, it is in the clause it said, after 4 years, suppose for the sake of an example, after 4 years, the debenture will be converted into equity share. That means up till 4 years, the interest would be paid, but afterward, it will be converted into the equity share, and hence, MP is the number of equity share in which you have converted. Again, you are taking the present value. The RV is the redeemable value, and therefore, here this is the case of a convertible debentures. Okay. Now, here the preference share. Now, if you have understood the bond, then the preference share understanding is too easy, because just the abbreviation used will be changed, but the base remains exactly the same. Just see that in this case, the formula is exactly the same. That is PDI. PD is preference dividend. I think everybody knows on the preference shares, on the equity share, it's not the interest, it's the dividend which pay. Okay, so dividend आप pay करते हैं, and therefore we use the word PDI. What do you mean by I? I is from 1 to n. That is, if preference shares have been taken for 7 years, 6 years, 5 years, that means n will become 5, and therefore this portion will be written 5 times for every year. Okay, and this will be the last, the 5th year redemption. That is, whatever the price of the share at the end of the 5th year, if the n is equal to 5. The same thing I have taken up in the debenture also. The only thing is, there I was taking I, that is the interest. Here I am taking PD, that is the preference dividend. Otherwise, the base remains the same. Okay. Now, just see, these are the connotations which I have used it. Now, this is there. आप ध्यान दीजिए. Suppose the preference share is irredeemable. That means the second component or the second part of the equation will not be there because it has not to be redeemed. When it is not to be redeemed, what is my formula? The formula remains that PD is the preference dividend upon P0. P0 is the net proceeds of the issue of the preference in the zero period or in the current period. Okay, that means what is the difference in the redeemable and irredeemable? In irredeemable, the second portion will not be there because the redemption has not to be there. That means only every year preference dividend will be there. But afterwards, in the case of a redeemable, the preference dividend redemption portion will also be there. That is the second component. Okay, now again in the preference share, if you remember the bond, you'll be able to understand this. Exactly the carbon copy. Only thing is the connotation, the abbreviations used will be different. Fine, because that is a liability. In the case of a bond, the interest is a liability. But here, the preference share, it can be a cumulative, it can be non-cumulative. In the case of the cumulative also, if 1 year you have not paid, you have to pay in the other year. Okay, and therefore, the formula exactly the same. That is PD, preference dividend, plus Pn minus P0. There we have taken RV minus B0. That is the difference in the redemption value and the today's value. Here also we are taking the same thing, divided by N upon Pn plus P0 divided by 2. Exactly the same. This is the approximate formula. Now it is KP. Here the dividend has to be paid by the company and that has to be written here. Now the third concept comes out is the cost of equity share capital. Now when the equity share capital is there, now every year the dividend would be paid. Whether it's a D1, D2, D3, Dn, whatever it is there. Concept remains the cash inflow is equal to cash outflow. The same concept is there. That is D1 means the dividend in the first year. D2 dividend in the second year and so on, and it has to be discounted because I have to find out the present value. The present value means we have to find out and divided by 1 plus KE raised to the power 1 for the first year, 1 plus KE raised to the power 2 for the second year and so on. If you have understood the basic bond principle, you can understood all the 3-4 components. Okay, and that is here, that is DN, that is the dividend paid or dividend received in the last year, that is nth year, and then at what price you have sold off in the nth year. Suppose I have kept it for 5 years. So, क्या करेंगे? D1, D2, D3, D4, Dn will be D5, and then in the 5th year, at what price you have sold it off, find out the present value of all the things, combine it, add it up, and then that will give you P0. Okay? Now, if you understand this is what it is there that I have already told you, but remember, there is no growth. There can be 3 cases. 1, the dividend can be growing or dividend can be constant. If there is no growth in the dividend, that means D1 would be equal to D2 is equal to D3 and so on. That means in that particular case, if I find out the zero growth dividend, then in that case, I can take up the formula, the easy one after applying the limits and everything, that it comes out to be D1 upon P0, a very simplified formula that is D1. D1 means the next year expected dividend, not the declared dividend. Expected dividend upon P0 will give you the cost of equity. Okay, that is there. Then afterwards, because E1 is equal to E2 is equal to E3 and hence no growth is there, that means D1 is equal to D2 is equal to D3, and hence on the basis of that equation, when both are there and 100% payment is there, that means E1 is equal to D1. When E1 is equal to D1, I can make the formula as E1 upon P0, and therefore the PE ratio comes out, that is the PE ratio comes out, and hence we can say 1 upon P0 upon E1 would be the PE ratio. Okay, and therefore the growth. Now there can be, in the case of the growth, 2 type of cases could be there. One, the constant growth could be there, another different growth could be there. When the constant growth is there, that means Dn would be equal to if I want to find out the dividend of the second year, then it would be dividend of the first year plus dividend of the first year into the growth rate. That will be the DN, and that is what I have done in order to find out the next year dividend, and hence the formula. Please ध्यान रखिए, it is T0 is equal to D1 upon 1 plus KE raised to the power 1, and D1 can be calculated like this. If it is D2, then 1 plus G raised to the power 2, Dn 1 plus G raised to the power n, and so on. And therefore, this will be, if you try to solve it up, that will be there. And this equation can be solved exactly like IRR principle, which we have already done in capital budgeting. But the condition here is the K is greater than the G. But now if we take up the previous equation, because my K is coming in the denominator, and therefore we simplified that equation, and that equation comes out to be D0 into 1 plus G. What is this? This is D1. D1 upon KE minus G. But why KE minus G? Because remember, if the growth rate is more than KE, the equation cannot be solved because denominator becomes negative. And therefore, please remember, the condition for this equation is that the KE should be greater than GE. And hence the formula comes out. You can write down D1 upon KE minus G, or you can write down D1 upon P0 plus G is equal to KE. It's again the simplification of this equation only. Now remember, this is what I have given you, that it is to be there, that D1 should be there, dividend has to be declared. Then in that case, KE, the G should not be more than KE, and therefore dividend payout ratio should be constant. Okay, the same thing. Now the third case, that is when the growth rate is different. Okay, it is not constant forever, which is practically not the case. Practically, it can be possible that you can have the growth rate same for 2 years, 3 years, but again it changes because the atmosphere, the economy changes, the competition changes, and every other thing changes, and therefore we can have the different growth rates. When we can have the different growth rate, we can have G1 as a growth rate, then we can have the G2 as a growth rate, and so on. Suppose we presume that here for the first 5 years, the growth rate is G1. That means it would be D0 into 1 plus G1. That you have understood in the previous equation also. But from the 6th year onward, up till the 10th year, the growth rate is G2. That means D5, because you know the growth rate is always on the basis of the previous year. That means D5 into 1 plus G2 raised to the power I minus 5 upon 1 plus KE raised to the power 6, 7, 8, 9, 10, depending upon which year you are taking. And in the last, again, the G3 is there. At the G3, you have applied the same thing, but you can extend this equation up to any number of time because the growth rate can be different in different years. Okay, and these are what I have written here. Now, just say varying growth rate dividend hoga. So that is actually a practical example. That the last equation, practically that is there, and hence what happens is in the case of the Kn, D1 into 1 plus T upon P0 would be there in the growth rate if the growth rate of dividend is 0. Okay, please remember that. And hence the cost of capital. You tell me, I'll ask you one thing. If in the cost of capital, whether the cost of capital will increase or decrease with the increase in the risk or decrease in the risk, can I ask you that the cost of capital has got the direct relationship with the risk or the inverse relationship? Can you tell me that? It's a direct relationship. As the risk increases, the expectations increases, and in order to compensate the expectation, the return has to be more. Okay, therefore, that is, we go for the beta factor also. Now, when we go for the beta factor, if you have heard, you must have heard the CAPM model, then in that case, what is cost of equity? The interest fixed rate, interest free rate plus interest free rate को आपको क्या करना है? The RM or KM You can say the RM, that is the return on the market, or you can say the KM, the cost of capital of the market, minus IF. IF is the interest-free rate. Multiply that by beta. And beta is nothing but a measurement of a non-diversifiable risk. What is non-diversifiable risk? The risk which cannot be minimized even by diversification of the investment in the various portfolio, in the various investment avenue, that you cannot minimize by that diversification principle also. That is called as a non-diversifiable risk, and here that is there. Therefore, we have to go for the beta factor calculation. This is called as a CAPM model, and this is a let me tell you, a very, very useful model even for the research purposes. Fine, and therefore, we have to go for that. Now, please remember the beta factor is a very important thing. The retained earning also we can calculate that. But you tell me, if I had to find out the cost of a retained earning, do you understand what is retained earning? Retained earning is the earning which the company has kept it. It's a profit of the company, but they have not invested that amount of the profit anywhere else. They are keeping with them. I'm asking you whether there is any cost of capital of that also. Yes, there is a cost of capital. Fine. Because you tell me, retained earning belongs to whom? To the owner. Equity shares belong to whom? To the owner. When we are saying the equity shares have got the cost of capital, retained earning has also to be find out that yes, it has also the cost of capital. Remember one thing, the year in which the IPO has come, in that year the cost of equity would be more. Fine, because some cost has been incurred as a flotation cost. But for the other years, the cost of retained earning and the cost of equity will be the same. Only when the difference would be there, I'm repeating it, the year in which IPO has come up, in that the cost of retained earning would be lesser as compared to the cost of equity. Otherwise, it's the same because both belongs to the owner. When both belongs to the owner, now I am coming that, okay, I have discussed the individual cost of capital, equity ka kara, debenture ka kiya, sab ka kar diya. But now how to find out the total cost of capital? Remember, the total cost of capital is nothing but the weighted average cost of individual components. It can be, just see, here, KE into W1, that is the weight. Kitna portion, how much is the proportion I have invested in equity? How much is the proportion? Suppose 40% I have invested in equity, I borrowed from equity. That means W1 will be 40%. I have taken W2 KD, that means cost of debenture. I have taken only 30% loan. So 40% मैंने equity से किया, then debenture मैंने 30% ले लिया. Then in that case the preference share. Fine. Another 30% from the preference share. I've just find out that, okay, what is the addition of all the three? And that will be the cost of capital. But now my main question and the last question is how to find out W1, W2 and W3. It can be on the basis of the market value of the share, debenture, preference, or it can be at the book value. At any value we can find it out, and therefore we have to divide that. Is it okay? Now, weighted average cost of capital, just see. I was just discussing, it can be the book value weight, it can be the marginal value weight, or it can be the market value or the target weights. Book value, the price at which you had issued. Marginal, if I have to launch a new product line, for that I need the additional capital of 100 crores. Those 100 crores, in what ratio I am dividing and what weight I am dividing, that will be the marginal weight. And therefore, we have to find it out, the book value weight, the market value. Remember, market value weight is being preferred as compared to the book value because that shows the current value, the current scenario of the company in the minds of the shareholder. But yes, the market value are very volatile. It changes very frequently, and therefore we prefer the book value weight rather than the market value weight. But remember, here we have to find out the market value is subject to change from time to time, and that is the main disadvantage. And therefore, what we do is the choice between the book value and the market value. Book value is more stagnant, but the market is not that stagnant. And therefore, we have to go for the marginal cost of capital also. That is the additional cost of capital. At what rate I am just raising the additional amount of capital, that is called as a marginal weight, and hence we go for the investors, the marginal weight, and the different cost of capital. The flotation cost is always there. The flotation, I have already told you, that is the additional cost of raising the funds. And now there is an illustration, and that you can take it up. This is the illustration. Equity, debenture, term loan is there. And after that, the weighted average cost is there that we have just taken up. That this is the cost of capital given to us. This is the proportion, that is 4 by 20, 4 by 20, and 12 by 20. We'll multiply correspondingly, and we will be getting 17.20 as the WACC, and that is what we find out. That is, this is the minimum, and this is per annum, the cost of capital. And hence, if the market price changes, then in that case, it becomes the KE changes. Fine, because the cost depends upon the market price, and therefore it is 20 by 160. Here it changes, and therefore you will look upon that the WACC also changes. Previously it was 20%, now it comes out to be, previously it was coming out 17 point, now it is coming out as 15 point. Why? Because the equity share cost has changed, and therefore we are taking into account the cost of capital, the tax rate, and the other thing, the rate of interest will be there. If I take the tax rate, again it will come down further, and therefore just see 7.2 and 10.8 will come out. And now if I'm taking that 10.2 and 7.8, it has reduced to 11.92. Just see the effect of the taxation, and therefore just here we can find out how it is there. Is it okay? Thank you. Today I'll find out. I have given you the exposure of cost of capital. I hope you have understood, and you just read it. If any query is there, most welcome to ask me. Thank you very much.